Hey everybody, today I have the pleasure of introducing our speaker for our June CFA events, Mona Mahajan. Mona received her undergrad from UPenn. She got her MBA from Harvard. She's been in finance for nearly 2 decades, most of that time spent on the buy side at various asset management firms. You may recognize her. She's a frequent contributor on CNBC and Bloomberg Television. And most recently, her role as a portfolio manager and the director and U.S. investment strategist with Allianz. So Mona, thank you so much for your willingness to come down and speak with us.
Absolutely. Thank you, John, for having me.
Yeah, absolutely. So Mona, she's going to be speaking to us about the macro outlook for U.S. and global developed markets. So I figured we'd do a bit of a sneak peek here with a couple of questions just as kind of to whet our appetite for the meetings next month. So Mona, obviously U.S.-China trade, that's the headline. We had a lot of noise this week. Where are we and what do you see the impact being on the U.S., maybe GDP, equity markets, et cetera?
Yeah. I think generally speaking, our base case continues to remain that the U.S. and China come to a trade resolution. There will be now more increased volatility, a little bit more contentiousness. What we're seeing in the markets this week in particular, though, is that investors are pricing in increased probability of a no-deal scenario. So, for a long time, we've been hearing we are getting closer. The rhetoric was actually getting more positive. In fact, many thought we'd get a deal done by this week. So President Trump's tweets on Sunday were actually quite a surprise to the market. It looks like the Chinese may have backtracked on some of the more fundamental structural issues that they were trying to address, including intellectual property rights, technology transfer practices, cybersecurity, et cetera. And so now what we're really looking for are for those issues to be addressed in any sort of deal. And I do think that the two sides have come back to the table. I think the negotiations are ongoing. But in the meanwhile, we will see tariffs increase. We do think if the no deal scenario does play out, which is not our base case, that will have a negative impact on a GDP perspective, as well as kind of secondary effects, consumer confidence, et cetera. The hit will be global, but primarily the Chinese and the US will be outsized impacts.
Sure. No, that's very helpful. Thanks. And maybe just one other quick topic here, and we'll wrap up this intro video. But S&P 500 in the U.S., we just hit fresh all-time highs just a few weeks ago before we had this sort of trade volatility this week. How do you feel about valuations? PEs seem reasonable, but how do you feel just generally about valuations?
Yeah, I think the S&P, it's very interesting because we've had a 25% rally now since the December 24th lows. But keep in mind, we also fell about 20% from peak to trough in Q4 of last year. So we rebounded nicely from that downturn. From a valuation perspective, we're looking at an S&P forward multiple of about 17.5 times. Now, this, in our view, is not stretched, but we're not at extremely low valuations either. However, when you look at the more macro backdrop, in an environment where inflation is low, rates continue to be low, you tend to get multiples that can be extended in some ways. So 18.5 times on a forward multiple is not out of the question in this environment, in this backdrop. So from a multiple perspective, we remain comfortable. If you look from a sector perspective as well, there are sectors that are trading well below their 5-year averages from a forward PE multiple. I point out healthcare and consumer staples in particular, defensive sectors that can do well in a slowing growth environment. So areas of opportunities we feel still.
Yeah, no, that's very helpful. Mona, thanks again for your time. We really look forward to hearing more from you. Again, that's June 5th in Chattanooga and June 6th in Knoxville. We'll see you then.
Perfect. Thanks, John. See you then.
Thanks.